Hi everyone, welcome to Internal Control Talks. Our goal with this podcast is to help you thrive as internal control professional by bringing you the best advice from industry leaders. Today we will talk about how to restructure and rationalize internal controls with Anna Moron. Anna is a risk and control consultant with over 25 years of experience in the world of audit, risk and controls, both for corporate and public accounting. Anna, welcome to the podcast.
Thank you, Cecilia. Glad to be here.
Great. I am glad you are here as well. Well, I would say let's start with a brief introduction. Give us a little bit of overview over the different roles and jobs you had in the risk and controls world.
Well, I started my career in corporate finance and then joined one of the big four accounting firms in 2003. As such, I was at the edge of Sarbanes-Oxley legislation, continued to perform consulting engagement, assisting companies first become compliant with Sarbanes-Oxley and then take advantage of new regulations to modernize and rationalize controls, keep costs as down as possible, and the ability to leverage the work into any GRC framework the company is looking to implement.
Great. And yes, you do have an amazing experience in rationalizing and modernizing SOX and, generally speaking, internal controls program. So I just want to dive into this topic, and let's start from the beginning. What are the signals that made you realize the need for an internal control rationalizations? And also, can you describe to us which are usually the struggles faced by companies due to inadequate SOX control structure?
What we are finding now is that many companies implemented their Sarbanes-Oxley programs or controls over financial reporting a few years ago. And it became sort of like a routine item to do. As such, when we come to look into a company, the first thing we ask is, what kind of risk assessment have you performed? Have you updated your controls for changes in the business? Have you taken advantage of the new accounting standard where you don't have to do such a detailed testing? But the key really is looking at the amount of controls, look at the financials, see whether it makes sense. Read the filings if the company is public, any other information the company provides to you if they are private, and try to get an idea as to what would be really those key drivers and key processes underlying them to understand the controls that enables the process to perform effectively and efficiently.
Mm-hmm. So based on what you just said, one of the key indicators that there is a misalignment between the risks and the controls is exactly that. So you start to notice that the controls that the company has in place are not aligned with the risks based on your analysis. Is that right?
Yes, that's correct. So one of the ways that we assist the companies to be more focused on the risks that they currently face, which may not be the same risks they faced 10 years ago or 5 years ago. A yearly risk assessment is something very desirable. And it does not necessarily have to be a separate function or a separate process that you perform. It's just part of leveraging all the various risk assessments management performs, and they don't even know they are doing it because they don't call it risk assessment. So you look at if you have an ERM framework, enterprise risk management framework, you try to obtain and leverage the results of the interviews or data gathering processes they perform, usually with the SMT and upper management, to get what are those big risks to the enterprise. Then you start bringing the risks a little bit lower.
Mm-hmm.
And you start talking with management at the senior level, functional level, and marry the two risks. Internal audit departments may perform, they do perform risk assessment in order to come up with an annual audit plan. If you communicate well with all these groups, then the Sarbanes-Oxley or controls over financial reporting risk assessment mainly just takes a lot of that information and that will provide you the qualitative assessment piece and then a thorough risk assessment in terms of materiality based on the financial statements at the group as well as any major component levels. That will enable you to identify the key locations, especially key unique processing locations, and enable to rationalize testing.
Mm-hmm. Mm-hmm.
For instance, some companies change from having local finance teams in each country in Europe to a shared service center environment. As you can expect, some of the controls become uniform and consistent for any of the entities the individual in the center is responsible for. As such, you are able to eliminate a lot of the testing that would have to occur in every one of those locations.
Yeah. Coming back 1 second to the first part that you highlighted. So to recap, starting from the big risks for the company, which can be in different type of documents, an enterprise risk management process or something like that. So that's you start from there, the analysis of financial statements as well. And then you go down to the senior level management. You integrate with any risk assessment performed by internal audit. So then you have this big universe of risks you are working with, and then you go on to work on materiality. So how to go about materiality?
First step, you look and you see, and then you obviously have conversations with external auditors, management, to see the level of materiality assessed in the past, determine is it still appropriate for this year. So, for instance, is deemed to be 8% of total revenue. Then you go and look into all of the legal entities within the group and start excluding the ones that don't meet that criteria. Then you can add additional factors like 3% of current assets, 100 million over in revenue. Various measures that management deems would make a prudent, informed investor be misled by the financial statements, and it will allow you to exclude the ones that will have no impact at all whatsoever. Mm-hmm. And that helps you focus the locations, and then you start overlaying qualitative measures, risk of fraud, separate processing, shared service environment, complex trade structure. You look at various qualitative factors and come up with an initial list of locations. Then you look at the locations and you figure out what are the type of activities they are engaged in, and look at what are the key controls within those locations and also in corporate, because sometimes the key control doesn't reside in the location. It resides in corporate by some form of management review control.
Yeah. So start to look at the controls where they sit and then really focus on these key controls. One key point to make here when looking at key controls, based on my experience, sometimes, especially companies under SOX, they tend to include a lot of controls which are actually not addressing directly any assertion on the financial statements. They do not have a direct impact on the financial statements, but still they are included. Especially one example that comes into my mind, which I've seen several times, are quality controls. So
Yes.
you find quality controls and then you ask yourself, but what exactly is the impact of these controls on...
Well, that's one point that you bring up. And that's when you are looking at key controls, you need to separate the operational key controls like QC. Quality control is a key operational control, but it's not a SOX control.
Exactly, yeah.
For instance. So it's just really understanding at the end of the day, is this going to result in a journal entry, in a disclosure, in anything that investors are going to rely on from a financial perspective, not from a company characteristic or best practices perspectives. They do have a financial impact, but it's a different kind of impact than what Sarbanes-Oxley legislation was seeking to prevent.
Yeah. I think when it was first implemented in companies, many of them, they didn't really kept that in mind. What you just said about a direct impact, results in a journal entry, results in a disclosure, and just they went full on and putting controls everywhere and anywhere just to make sure they were covered.
One of my clients had thousands of controls when I got there. By following through, again, the risk assessment and looking at the types of controls that they were testing, I was able to bring it down to like a much more manageable number of around 500, more or less, key controls. I validated my understanding with the auditors, and we came within 20 controls of one another. So we were in the same page, and I made sure that we were.
Yeah.
And most of the controls that I excluded were related to operational matters, much more than internal controls over financial reporting. I was not telling them stop doing it. I was not telling them it's not important, but I was just telling them I am not going to spend time and money to test it for Sarbanes-Oxley purposes. I rely on internal audit to pick up the review and assessment of those key operational controls outside of, again, internal controls over financial reporting. That's why it's important to have a good, thorough, holistic view of risks and controls via a governance, risk and compliance framework. We all hear about GRC, and that's what GRC really attempts to do, to give a consistent view of risk and controls for various purposes to the company management.
Yes, I'm totally with you. And I find a lot of confusion on this topic. For example, I was talking with a company a few days ago working in insurance, and they were telling me, oh yeah, we do have controls in place, and we do have a company which takes care of consulting on these controls. And then talking with them and going a little bit deeper, I understood that the consulting company was advising only on controls that allow them to comply with the specific the regulations in the insurance world. That doesn't mean that they were covered for any other type of risks. They just address the risk related to the compliance with the law. Then you look at different set of controls. Sometimes, obviously, they can be overlapping, but not necessarily. And I think this is where the confusion starts oftentimes.
Yes, and also the overabundance of laws and regulations in terms of controls can be overwhelming.
And I'm curious about your experience in dealing with resistance that comes with this type of projects.
In the beginning years, I had an executive threw a bottle at me when I told him basically that he needed to do some improvements and change the modus of operandi. But that was only once, thankfully.
That's good.
In general, they need time to absorb what you have just told them. Sometimes it's too optimistic to think that you will come back with a reaction or a next steps out of an initial meeting where you are just discussing current state. This is what you have. And some of them are much more mindful of financial reporting. It also depends. CEOs and CFOs are very welcoming to all of these opportunities to improve because, let's face it, they are signing a 302 certification, so they got the most skin in the game. And in general, everyone accepts, and sometimes it's like with any other audit. The initial presentation of the efficiencies may be a little controversial, or it may be a little bit adversarial. But that's what you need to avoid at all costs when presenting your deficiencies. You do not need to create an adversarial relationship with the auditee. And the auditee at first may have thought really that he was running the best process, but you need to make a partner out of your auditee and help them understand that it's not the auditor or the control specialist's responsibility. We don't own the controls, they do. And if they don't think that's a control worthy implementing, more likely they'll do a half-hearted effort and stop doing it as quickly as they put it in place. So you need to really work with them and have a good way to provide follow-up to some of these findings or improvements that need to be made to the internal controls. That brings less time spent testing, less cost, less external audit fees cost. The better your program is, the more that will rely on it. Another thing that I insist on all of my clients is that controls are not separate activities from your processing every day. Controls should be embedded within your process. It's not that you have to do your process and then, oh, I forgot, I have to do this separate because it's a control that's going to be tested. That's just not a very good use of time and certainly not a good control, because clearly what management is relying on is something that relies within the process, not an activity that is just performed so they can show a signature, for instance. Consider having internal audit who are independent, perform the testing. Yes, it's great that management will perform their own testing, but then it cannot be relied on by the external auditors. And audit assessed is a large chunk of money that you can be saving just by having a properly run, reasonable number of controls, good communication throughout the year. That will make it a lot better of a program, Sarbanes-Oxley program, where you leverage the most.
Yeah. Other than rationalizing internal controls in their numbers, did you modernize any other part of the internal control assessment process as well while working for your clients?
Yes, I had the opportunity to assist in several occasions with the implementation of risk and control systems, GRC systems, such as teammate in some cases metric streams, Paisley, various systems that were used not only as control repositories, they were used as project management tools and also to track testing and document the results of testing. So it helps, especially for large corporations with multiple locations and lots of controls, is the best way to then be able to summarize the data for the audit committee out of the system. But PMO has to be strong in enforcing the use of the system. Otherwise, like I like to say, garbage in, garbage out, you know?
Totally. I love that. I love that sentence because I think it sums it all up. And also another way I usually use that sentence is when people ask me about, oh, why should we have controls? And I tell them, because you want your numbers to be correct. If you enter crap in your processes in terms of numbers, then when you build your financial statements, it's going to be crap out. So you're going to actually look at numbers which are not real. They're just made up because you don't have the processes and controls to build and process numbers correctly.
Correct.
So I love that sentence. And what would be your final advice to fellow professionals facing the challenge of restructuring internal control frameworks?
My biggest word of advice is not to stay away from your risks. Keep your eye on your scoping memo. Keep your eye on the overall program. Don't forget both quantitative and qualitative aspects of the risk assessment. And if you do that, you will be able to keep a pulse as to where the business is going, where you need to make changes, and where you have opportunities because of changing business model to rationalize.
Fantastic, Anna. Thank you very much for being with us today to share your experience and to provide our audience with such valuable takeaways.
My pleasure, Cecilia. Always happy to assist the professionals in internal controls.
Thank you for listening to this podcast. If you enjoy it, make sure you like it and share it. If you want even more resources on how to be extra effective as internal controls professionals, check out our website www.internalcontroltoolbox.com and subscribe to the email list. Thank you for listening and see you in the next episode.